Hello, and thank you for tuning in. Today, we will be focusing on 401k retirement plans. This presentation is brought to you by the California Society of CPAs. My name is Darrell Young, and I am a volunteer board member and the chair of the Financial Literacy Committee for the Peninsula Silicon Valley chapter of CalCPA. I operate a wealth management practice in the San Francisco Peninsula area. We intend for this presentation to be interesting and informative. The data points contained herein are believed to be current. However, please note that this presentation is intended to convey general information which may not be applicable to your personal situation. Please do not interpret the information here as advice for your personal circumstances. You should consult with your personal advisor, or certainly feel free to give my office a call. Now, as already mentioned, today's agenda will provide an overview of 401k retirement plans. We're going to cover a lot of ground in the next 12 minutes or so. Certainly, this presentation is not going to enable you to be an expert, but we will hopefully touch upon the high points of the subject matter. As you can see on the left-hand side, our agenda for today is going to cover an introduction to 401k plans, their origin, the benefits of participating in such a plan, the investment choices, what you might do if you leave a company or leave a plan, tax effects. But before we get into all that, I'd like to reiterate that we believe the cornerstones for financial success are planning in accordance with your goals and your risk factors, giving back to your community, working with people whom you respect and trust, and maintaining a positive attitude and competitive awareness at all times. According to us, these are the cornerstones for financial success, and if you are following these behaviors, we believe that you have the makings for success. Time is our most precious resource. There are no shortcuts. So what exactly is a 401k retirement plan? Very simply, it is a tax-qualified savings plan established by employers where the employees may make salary deferral contributions and the employers may make matching contributions. From an administrative perspective, we see that the contribution limit for 2015 this year is $18,000, unless you happen to be 50 or above, in which case you can do an additional $6,000. For the purposes here, we're going to be focusing mainly on traditional 401k plans, which are deferred in terms of taxes until the proceeds are withdrawn, in contrast to Roth 401ks where the taxes are paid upon contribution. We'll also look at distributions, but note that the age at which you can start taking distributions, unless you're subject to certain circumstances, is 59 and a half. Looking at the history of 401k plans and how they came to be in existence, we see that in the earlier part of the 1900s, defined benefit pension plans were more prevalent, and then in the 80s or so, I think companies began to shift into defined contribution plans, of which a 401k is a subtype. I think that from the company's perspective, it became financially challenging to guarantee pension benefits for an unknown period of time based upon the longevity of employees, and therefore we saw the shift into defined contribution plans. 401k is probably a term that you've heard many times before. Now, the prevalence of them has really grown, and to the point that we're now talking about in modern days trillions of dollars invested in 401k plans. But very quickly, looking at the difference between a traditional and a Roth, you see, again, as I mentioned earlier, that the contributions are tax deferred in the case of a traditional 401k, but post-tax in the case of a Roth 401k. Let's look at the example on the right-hand side. So if we see a hypothetical employee drawing a salary of $40,000, and that employee has elected to defer 10% of his or her salary to the 401k, that amounts to 10% of the $40,000 or $4,000. The amounts are the same between the traditional and the Roth, but the distinction is in the tax effect. Now, side note, the employer in this particular case has agreed to match up to the first 6% of the employee's deferral. So the employer's matching portion is the $2,400. You see there that the total contribution at the end of the year is the $6,400. This, of course, does not take into account any market movement with respect to the investments. Now, in the case of the traditional 401k, you see that the $4,000 helped to reduce the employee's taxable income for the year. So the taxable income in a very simple circumstance became the $36,000. However, in the Roth circumstance, note that the $4,000 contribution was an after-tax contribution. So the taxes had to be paid up front. The employee's taxable income, or the take-home income, as you can see there, is significantly less on the Roth side. Now, knowing all of that, what are the benefits to participating in a 401k? I would say that automatic savings with a tax benefit is a huge reason to participate in 401ks. And along with that, you get compounded growth. So take the example of somebody who, in this case, starts at 27 years old, contributes $5,500 per year for 40 years until that person reaches 67. If you assume an average growth rate of 6%, you see that it has grown to over $900,000 over those 40 years. And again, this is the power of starting early and being consistent in your investing. And I would say also that for a lot of people, making it an automatic transaction, meaning that it's taken out of your paycheck automatically, I also think that that is a helpful feature. What would your investment choices be? Well, typically in a 401k plan, you would have access to a variety of mutual funds. I would say probably choosing from anywhere from 20 to 30 different mutual funds. You might also have access to index funds that, as the name indicates, track very specifically an index such as the S&P 500. Of late, you probably see things like target date funds, and those are funds that are managed to a particular time period. So for example, if I happen to be the person in the previous example who's 27 years old, and I'm going to work for the next 4 decades until I am 67 years old, well, then I might choose a target date fund of 2055, and that would match my time frame, again, because that's 40 years from now, resting assured that the target date fund's manager is going to more than likely be aggressive now, and as time goes on, tone down that aggressiveness to match my life circumstances and my age. Qualified default investment alternatives are useful for those folks who, for example, decide that they want to defer 10% of their salary, but for whatever reason did not put down an investment choice. And so the QDIA becomes their default or their automatic investment choice. Question to the side, which I think is rather interesting. Would your 401k affect, for example, your child's eligibility for college financial aid since it's an asset to you? And the answer we found is no. Retirement assets are not included in calculations pertaining to student financial aid. Now, what are your choices if you perhaps leave your company or leave the employer? Typically, you have 4 choices. If you have more than $5,000, generally speaking, you can leave your assets in that existing 401k plan. Certainly, you can take a lump sum distribution, meaning that you take out the amount subject to any taxes and penalties that may apply. If you, for example, leave an employer to take a job at a new employer, and your new employer has a 401k, you can transfer the assets to your new employer's 401k. Last but not least, you can roll over the assets to an IRA. I would say that the benefits to rolling out to an IRA are that you can invest in virtually anything, as opposed to what is offered to you in the 401k plan, which, like I said earlier, is generally a menu of, call it 20 to 30 different funds. Another interesting note, can your 401k plan assets be seized in some sort of lawsuit, such as bankruptcy? And in general, unless the creditor is a government agency, like the IRS, and perhaps unless other extenuating circumstances, criminal circumstances apply, typically they cannot be seized by general creditors. How might the taxes apply at the time of distribution? Well, as we said earlier, in the case of a traditional 401k, you did not pay taxes upon contribution, and it helped to lower your taxable income in the year of contribution, but When that money is taken out in retirement, for example, it will be treated as income to you and be subject to taxes. Now, if you happen to need the distributions before 59 and a half, as I mentioned earlier, you may be subject to certain penalties, call it 10% federal plus some amount for state, unless you are exempt based upon some of these specific situations, such as medical expenses or first-time home buyers, qualified higher educational expenses. Now, getting assistance. What role can your financial advisor play? Well, as a financial advisor, I can serve both the employer and also the employees, individual participants. With respect to the employer, I would hope to bring value in terms of introducing a platform which would help employees participate, get them to enroll, help them to understand, make sure that the employers are maintaining their fiduciary responsibilities, and make sure that the plan is operating efficiently on an ongoing basis. On a one-on-one level, I'm always happy to help out the employees, the participants, with understanding the 401k, setting a prudent asset allocation, encouraging to save, and how this all factors into their personal financial plan. Now, we tried to cover, again, a lot of ground in 12 minutes or so. The retirement plan space is rich with other related subject matters. For example, we didn't spend a lot of time on the Roth 401k. We didn't talk about IRAs or SEP IRAs. We didn't talk really at all about pension plans or deferred compensation plans. Hope that we'll see you at future presentations discussing some of these subjects. Again, my name is Darrell Young. I'd like to thank you for your time and attention during this presentation. I hope that it was interesting to you. I welcome your comments. Thank you very much.